News Talk 94.5 WPTI, 96.7 FM WTOB. You're listening to the Wealth Guardians Show with Garrett Ray and Brice Payne, helping you retire the job and keep the paycheck. And this morning, we're talking about the biggest money mistakes in retirement planning. How you doing, Brice?
Doing good, Garrett. Doing good. How are you?
Doing all right. So me and my buddies have a newfangled idea that we want to run a marathon in October, to be specifically the Marine Corps Marathon in Washington, D.C.
No kidding.
So, yeah, I am slowly getting back into running. I used to run cross-country and track in high school, went to college, did the military thing, gained a lot of weight in between. When I was running competitively, I weighed about 170 pounds, and then through military stuff, got up to about 215. So I'm learning what it's like to run many miles again. So that's been interesting for me.
And so that's in October.
In October, yeah, October 28th, I believe.
What is your regimen for getting in shape for something like that?
Yeah, so trying to at least start with running 20 miles per week now, working all the way up to about 50 miles per week. Probably by early October, and then you kind of taper down as you get closer to race day. So,
very good.
Yeah, so it'll be an interesting fall. Getting married in September and then running a marathon in October. We'll see if I can handle it. So
very good. I think I'd be up to cardiovascular wise being able to do that, but my ankles and my knees would not be up for that anymore at my age. Yeah.
It's. I used to love running hills, like specifically running downhill when I was younger. Not so much as I get into my later 30s. So yeah.
I don't want to get too much into this, but where is the route up there for that?
So you start at Arlington, actually,
beautiful.
And then
beautiful.
It is beautiful, and then you cross over the bridges into Washington D.C. proper, and I believe you end at the mall, kind of like where the Smithsonian Capitol Hill is. So it should be pretty incredible. We've heard it's one of the best marathons to do, particularly for beginners, and I'm very much a beginner. So,
well, very good. That's cool. Yeah. You and I have something in common this year then, because I'm going up there for Memorial Day to do the Rolling Thunder ride for the veterans. I'm going to be on a steel horse, but you will be on your legs. But nonetheless, we're going to be doing more or less the same route.
Oh, that's awesome.
That's very good. All right. Well, while we're speaking of that, let's go ahead and do our Wealth Guardian Service salute to all of our men and women in uniform out there, our veterans. Thank you for putting on the uniform and sacrificing the sacrifices that you've made and your family have made for our country. We thank you, and you are always in our thoughts for that. So, Wealth Guardians, giving that figurative salute to everybody out there. And Garrett, thank you for your service as well. Doug is on a vacation in Aruba right now. And,
he is.
Yeah. Doug, thank you for your service as well.
Yeah. But he will return to the airwaves next week, folks.
Very good. All right, Garrett. Well, so the biggest money mistakes in retirement planning here. Give a lead up to this.
Yeah. So, as we kind of sit down with people throughout the community and we talk about, what are their goals and kind of desires as they start to enter that retirement window, or at least they're thinking about it, or for some people, they're actually already retired and just looking for kind of a second opinion. There's some common themes that we see, Brice, and that's really what we want to go through with the audience in this episode. And, one of the first things that comes to mind is, tax implications in retirement are a lot different than when we're working, and the tax implications of your retirement savings can be fairly complicated, and they are taxed in different ways that we're not used to when we're bringing home the paycheck and kind of, if you will, a W-2 employee. So why don't you expound a little bit on kind of some of the things that we see and folks should keep in the back of their mind?
Well, we'll say it simply. We've got a lot of these to go through, so I don't want to go into too much debt on each one of these. This is just kind of a high-level cursory view of all of this. But if you are, say, 60 years old and you haven't retired yet and you've been saving for most of your life, you're probably familiar, maybe you do your own taxes, you're probably familiar with the adjusted gross income and maybe perhaps long-term capital gains and short-term capital gains. That's not going to be irrelevant in retirement, but you probably, or you very likely, are not aware of what provisional income is or what modified adjusted gross income is. Well, those factor in different things, and those are very relevant to figuring out what percentage of your Social Security is going to be taxed when you file for Social Security. 0%, 50%, or 85%. You're going to fall into different tax tier levels of Medicare, and factoring in not just your adjusted gross income, but other things that do not fall into adjusted gross income. You need to be aware of those. And there are things that you can do years ahead of time to make sure that as you go into retirement and you start having other sources of income besides W-2 income, how to pay Uncle Sam what you owe him, but making what you owe him less than what it would have to be.
Right.
And so that's one of the things that you have to have a financial planner on your side to be able to look years ahead and make sure that you're doing things in the proper order. IRAs to Roth conversions is just one of those things. A lot of different things that you can do. I don't know. Again, we don't have time to go into 5 minutes on each one of these. So that's one. Ignoring the future tax implications of your retirement savings, you've got to have a financial planner on your side to help you through that.
Gotcha. Understood. Well, thank you very much, Brice. One of the other things that we, commonly have discussions around, you mentioned it in the previous topic, is just Social Security in general. When do I file? What's the right way to file? And some of the topics we get into is potentially starting Social Security too early.
Yes, that's something a lot of people want to do or think that they want to do. You can file for Social Security as early as 62 years old.
Yep.
You could file for it as late as 80, but it doesn't make any sense to ever file for Social Security later than 70. But there are a lot of different factors that go into what makes the most sense for you long-term wise. Filing as early as you can at 62, just so you can get your hands on that before it disappears, as a lot of people are afraid of. Or do you file for it as late as possible, age 70, for delaying tax implications of that and to let it grow? Social Security grows at 8% a year, more or less, every year that you don't take it from age 62 to age 70. Well, that's a guaranteed growth rate. That's not dependent on anything else. The IRS has said this is what, or Social Security admin has said this is what it will grow. Well, it's a guaranteed rate of return of 8%. That's pretty big. If you have to lean on your other investments and delay filing for Social Security, are those other investments guaranteed to grow at 8%? In all likelihood, not, because you and I are not aware of any other investment that's guaranteed to grow at 8%. So, taking into consideration, maybe you want to get your Social Security as soon as you can. We get that. But does that make long-term financial sense for you to do it? More often than not, it does not. So you want to, again, have somebody, a financial planner, perhaps somebody like us at the Wealth Guardians, who is certified with the National Social Security Association, who can help you figure out what makes the best long-term sense for you in your filing strategies.
Yeah, I would happen to agree.
Very good. If you're just tuning in, you're listening to the Wealth Guardians with Doug Ray. In his stead today is Garrett Ray and myself, Brice Payne. And today's topic is the biggest money mistakes in retirement planning. We're going to be talking about this on the first and second segment. So, Garrett, what's the third one that we've got going on here?
Yeah, this is basically talking about the way someone's portfolio is invested and kind of the allocations they have within it. Sometimes we get folks who really just want to shoot for the moon and they're super aggressive about their investments, almost solely focused on just return. And then you get, of course, the flip side of that, people who are just completely scared of any type of investment that's tied to the market, and they essentially want cash or cash alternatives, and they're just so conservative. So, what are your thoughts on proper kind of portfolio balancing and that sort of thing as we enter retirement?
Yeah, there's different types of risk out there. For somebody who's conservative and they think, well, I just want to have all my money in the bank. Okay. I get that. But there's different types of risk out there. Most of us are familiar with market risk and equity risk. Market risk is whatever your investments are going to go up or down based on what the market does as a whole. Most of us are familiar with that. We might not put a name on it, but that's what that is. Then there's something called equity risk. Maybe you're not invested in the market as a whole, but you're invested in Tesla and Facebook. Yep. And that's your two main investments. Well, if you'd invested in those 10 years ago, probably a pretty good investment. But you're not subject to market risk. You're subject to equity risk of those two companies.
All the eggs in one basket.
All the eggs in too few baskets.
Yep.
So most of us are familiar with that concept. We get that. But then what if you just had all of your money in the bank? Are you completely free from risk? No, because there is another risk out there called inflation risk. And you have to be in an investment that over a long period of time, at the bare minimum, keeps up with inflation. Yep. And if we've had inflation now for 9%, like we've had for the last couple of years, or somewhere in that vicinity, 7 to 9%, depending on what you're listening to, you probably, I guarantee you were not getting that in your FDIC accounts.
No.
So you were subjecting yourself not to market risk or equity risk, but you were subjecting yourself to inflation risk. So there's different types of risk out there, and you have to have, again, a financial planner on your side who can help you figure out what the time horizon is for your money, what types of risk you feel comfortable with, and what kind of fluctuations in the value of your accounts can go up and down. So you got to have a hand in all of that. Now, something else that we can help you get a handle on, and we do seminars on various subjects, as you know, out there. We do it on Social Security. We do it on tax planning. Well, we've got some seminars coming up here in the coming weeks on Tuesday, May 16th, and again at Thursday, May 18th. The seminar that Garrett and I are doing is Retirement Success in Turbulent Times. Doug's going to be there as well. Retirement Success in Turbulent Times. Well, we've been having turbulent times for the last year and a half, 2 years now.
Oh boy, have we.
So it's kind of topical. It's at 6:30 p.m. at our office space at the old library in Clemens, the Broyhill Annex. You do not have to pay to be there, but you do have to register so we know who's coming and how many people are coming. And the best way to do that is by calling us at 336-391-3409. That's 336-391-3409. For all of you tech heads out there, there's another way you can register with us. You can go online, go to our website, thewealthguardians.com, and click the events tab and register with us that way. Again, no cost or obligation, but we do want to know who's coming. We're going to do more seminars throughout the year, and we're also going to do a second segment after the break here. We're going to continue with the biggest money mistakes in retirement planning. But of course, as always, it's Garrett's turn to ask me a trivia question this week. Garrett, you ready?
I am.
Am I ready? That's the question.
Yeah, are you ready?
Am I ready? I don't know. You throw it on me. I'll tell you if I'm ready or not.
So we're going to switch gears, Brice. As we all happen to be here at the Wealth Guardians, a big history buff, so a little history question for you.
Very good.
And the question is, in what month was Julius Caesar assassinated? You'll have to noodle on that one over the break.
Okay, and what month was Julius Caesar assassinated? All right, well, I will think about that. Could I have like a 1 out of 12 shot there?
You do have a 1 out of 12 shot, that's right.
All right, very good. Well, stick around for the answer to that trivia question on the other side of this short break. This is Brice Payne. With me is Garrett Ray. The show is The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB. News Talk 94.5 WPTI, 96.7 FM WTOB. You're listening to the Wealth Guardian Show with Doug Ray, helping you retire the job and keep the paycheck. I'm Brice Payne, along with Garrett Ray. Doug is in Aruba this week. And in the second segment, we're going to continue our topic on the biggest money-making mistakes people make in retirement. Now, Garrett threw a trivia question at me this morning, and we're going to get to that trivia question. But before we do that, I've got 2 questions for you. A, are you looking forward to your retirement? B, do you want to make sure that you're making the best financial decisions for retirement? Well, if you're smart enough to turn on the radio to us this morning, then I'm sure you're smart enough to have answered yes to both of those questions. We here at the Wealth Guardians, therefore, have a no-cost, no-obligation second opinion review of your retirement plan waiting for you. It includes a deep analysis of your assets, your investment portfolio, your insurance policies, your income needs, your risk tolerance, your risk exposure, tax mitigation strategies, legacy goals, and the fees that you are currently paying. Our goal is simple. It's not complicated. We want to help you lower your fees, align your risk, and improve your overall retirement picture so you can retire the job and keep the paycheck. But the ball is in your court. You have to give us a call, and our number is 336-391-3409. That's 336-391-3409. Give us a call or visit us at thewealthguardians.com to set up your financial plan review with Doug, Garrett, and myself today. Remember, the markets aren't going to wait for you. Okay, let's go ahead and get to that trivia question Garrett had for me. Let's see if my little bit of history knowledge might come into play here.
All right, so for those who missed it in the first segment, the trivia question is a significant moment in history, the start of the downfall of the Roman Empire. And my question to Brice was, in what month was Julius Caesar stabbed and killed?
E2 Brute. So I've got a 1 out of 12 shot, but this is March, was it not?
It was.
The Ides of March.
Beware the Ides of March, which is the 15th of March. That's the exact
Okay,
day.
well, I didn't know that. If you'd asked me the date, I wouldn't have known that. Okay.
Yep. The Ides of March is the 15th, right in the middle of the month.
Perfect. Oh, well, so hey, wait.
Yeah, I was about to say.
There we go. That's right. Got to get that ringer out when we do it right. And once again, Garrett and I both prove hard to stump. So, all right, let's go ahead and get back to our topic here. Garrett, we left off with last time with being too aggressive or too conservative, and we talked about the different types of risk out there that one can subject themselves to.
Right.
What do we got next?
Yeah, so, we are talking about the biggest money mistakes in retirement planning, and man, is this one fairly common. Taking advice from friends and family on how to invest. I have to kind of just pause when I hear a story like this, because I often wonder, sure, you may be talking to Uncle Bob about his stock portfolio, and he may have a lot of winners. Is he really telling you about his losers?
Good point.
Often not.
Yeah,
and
it's not something you brag about.
Yeah, and so it's when you get the kind of, let me show you my portfolio guy, I just often kind of wondered what positions they're showing. It's almost always the winners and none of the losers. So, well,
I liken that to, this is what my neighbor did, and he's very successful, so I'm going to do that too. We might define success differently from our neighbor. Our needs, our income needs and our expense needs and our growth needs might be different from neighbor to neighbor. And the simple question, because your neighbor is taking a certain medication and he seems healthy, does that mean you're going to jump on the bandwagon and take that same medication?
Right. That would be absolutely silly.
Right. It would be. It wouldn't make any sense. So you'd probably want to talk to your doctor and see what are the differences between your neighbor's health and your health that would require you to take a different medication, if any medication at all. So no, you would not want to take advice from a neighbor unless perhaps they are a licensed fiduciary and they've asked all the right questions of you. And your situation happens to be almost identical, therefore warranted to use the same investments that your neighbor uses.
I would agree.
Yeah, so not a very common thing for people to do, and it's not one that makes a lot of sense when you peel back the onion a little bit.
Absolutely. Another big money mistake that we sometimes encounter is little to no diversification in their investments.
Not diversifying your investments. That could work out really well. Again, we said this in the first day. If you invested in Facebook when it was an IPO, then it probably worked out well for you. If you invested in Apple when Bill Gates took the helm back from after he had been fired the first time, Apple just exploded. But those success stories are few and far between, and you do not want to not have a diversified portfolio because, as we said, you're taking on not market risk there, but equity risk. And the idea behind a retirement portfolio is to limit your risks. Again, there's about 11 different types of risks out there. We don't have time to go into them all. But just because you're not taking any inflation risk, you're taking a lot of equity risk with a plan like that. So, again, you want to talk to a financial planner and make sure that you're mitigating out all the risks there as best you can. Speaking of that, speaking to a financial advisor, you can always give Garrett and Doug and myself a call at 336-391-3409. To sit down with us. There is no cost or obligation, just your time and your gas to get to our offices, and we can see what help we can provide you in smoothing out your retirement plans so it's operating on all cylinders, so to speak. All right, Garrett, what do we got next?
Yeah, the next one that we encounter occasionally is relying solely, or at least very heavily, on only employer-sponsored retirement plans, so like a 401k, a 403b, that sort of thing. There's a lot of good things about 401ks, 403bs, namely the contribution limit is much higher than an IRA or a Roth. So that's good for the individual. But there are some drawbacks too, Brice. And so what are some things that you've encountered that the folks need to know about?
Well, I got my start in this business with T. Rowe Price and on the IRA side, but they have a large 401k plan department as well. And when your employer puts together a 401k plan with a third-party administrator, they are not using the cream of the crop, best of the best mutual funds out there. You can get into the reasons why, but they're kind of piling together a number of mutual funds that don't have the number of investors or the amount of dollars invested in them that they would like to see. So they're trying to force those onto people because when you invest in a 401k plan, those are your only options. So if your employer-sponsored plan only has 20 mutual funds in it, if that's the only program or the only way that you're investing is through that 401k, instead of having tens of thousands of investment options that should be available to you, you've only got those 20 or so mutual funds. Well, even those aren't the best of the best mutual funds in most cases. So you're really limiting yourself. As you said, you're also limiting yourself to that more or less $22,500 amount.
Yep.
Well, so maybe you've got enough money to invest $30,000 or $40,000 or $50,000 a year into your retirement plan. If you're maxing out your 401k, does that mean, well, I'm maxing out, therefore I'm not going to save the rest of my money? Yeah. No, of course not. So there are other ways that you can go about it outside or on top of your 401k. And granted, there's a match with most 401k plans, Not all of them. You definitely want to take advantage of that.
At least a match, yeah.
But beyond that, perhaps look into investing in an IRA. And then if you've maxed out your IRA, go back to your 401k plan to max that out. And then if you've maxed that out, then you could look at a non-qualified or a brokerage type of retirement plan for yourself.
Agree. One thing, too, that we commonly run into is someone who just has an inability to adjust their investment strategy as they get closer and closer to retirement. And I think a lot of this has to do with a little bit of recency bias. There's folks who have had a long established career, and kudos to them. They had the strong bull market of the 1990s. And then after we got through the dot-com bust and the great financial recession of 2008, 2009, we had another really strong bull market from 2009 really until 2022. And they've had a lot of success. And if they were in the wealth accumulation phase of their life during that time, they likely were fairly aggressive in their investments. And as they get closer and closer to retirement, your time horizon has now shifted.
That's true.
And so do we need to take another look and possibly pivot on that strategy, maybe de-risk the portfolio some to be a little bit more appropriate for someone who's in their mid-60s, possibly going into their 70s. So.
Yeah, you hit the nail on the head there, Garrett. Let's ask everybody out there, rewind the clock to when you were, say, 40 years old, and you were planning on retiring when you were 65. Were you okay at that stage of life with a 35% loss in your portfolio?
I got 25 years to make it up, Brice.
Not that you were happy with it, but were you okay with it? Most people would say, yeah, I was. All right, well, now let's fast forward the clock to wherever you're at now. Maybe you're 60 years old or so, maybe a couple of years from retirement. Are you okay with a 30% loss in your portfolio now? Most people would say, no, I'm not. Yeah. Well, then here's the question I've got for you. Have you adjusted your portfolio and the market risk that you've got it exposed to year after year as your risk tolerance is dropping? We have seen it time and time and time again that people say, well, I don't understand. My risk tolerance is down here, but the risk in my portfolio is way up there. I wasn't aware of that.
How did that happen?
How did that happen? Because you've still got the retirement plan that you were okay with 20 years ago. Yeah. And you haven't adjusted it. You've got to adjust that. Let a financial planner like the Wealth Guardians, who have our licenses and our certifications to be fiduciaries, walk you through that risk mitigation process and show you where the weaknesses or the weak links in your portfolio are, and help you adjust those to where if the market does drop 40%, it's only taking on the losses that you feel comfortable with. It's not that hard to do, but you should have somebody who's licensed and experienced in the field to help you do that. And that's what we are here at the Wealth Guardians. Again, 336-391-3409 is the best way to do that. And Garrett, before we have to go here, because I see that clock ticking up on us, let's go ahead and mention again that we are doing some seminars coming up here on Tuesday, May 16th. And Thursday, May 18th. It's Retirement Success in Turbulent Times. We've been doing this seminar for a couple of years now, and boy, is it hitting true for the last 18 months or so. We are in some turbulent times right now. Yep. Nobody would have guessed 18 months ago that we would have seen the interest rate hikes that we have seen. This is the most interest rate hikes and the largest overall total amount interest rate hikes that we've seen in this short period of time.
In the shortest time frame, yeah.
Right. They're all condensed together, just like that V recession that we had with COVID. and this is like just exploding the interest rates, and mortgages are not the same as what they were a couple of years ago. Let us help you figure out how your portfolio needs to be adjusted for that, especially if you are approaching retirement and you're leaving that wealth accumulation phase of life to the wealth distribution phase of life. Our phone number to register for this, there's no cost or obligation, but it's 336-391-3409. That's 336-391-3409, Tuesday, May 16th and Thursday, May 18th at our offices in Clemens. If you don't want to call us, and which I don't know why you wouldn't, but if you don't and you want to go ahead and just register by going online, thewealthguardians.com, and click the events tab. I think that is about all the time that we've got. Garrett, did I leave anything else out?
I think you did great, Brice. Thank you.
All right. Well, I look forward to seeing you train here week in and week out, and I'll go ahead and get my bike in shape for the Rolling Thunder Marathon, so to speak, in a couple of weeks. We hope the rest of your weekend is everything you want it to be. This is Brice Payne along with Garrett Ray. The show is The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB.